Hello everyone, this is AJAY SHAH and you are watching AJAY's Costing Concepts last minute revision lectures, that is key to exemption for paper number 5, Strategic Cost Management and Performance Evaluation. So today this lecture what we have is for a revision, quick revision of chapters like transfer pricing and pricing decisions or pricing policies. We are here to do a quick revision of these chapters. This is the last minute revision that you should go through before you appear for your exams. So it will be a quick revision, it will be a glance, or it will be a full revision of your chapters in an easy manner, in the best possible manner. And what are the charts, what are the methods, what are the things, what are the key points, what are the presentations that you should do, and how it should be disclosed in your exams. That is what we will be discussing today. So keep watching this video. It is for pricing policy and transfer pricing chapters what we have been revising today. So the first thing what we want to discuss over here is the pricing under different markets. So that this is one of those theory questions. What are the different kind of markets and how the pricing can be set, or what are the things that we should understand. So first let us understand what are the different type of markets we have. We have perfect competition market, we have monopolistic market, we have monopolistic competition market, and we have oligopoly market. What are the key features of this market? In a perfect competition market, there are homogeneous products. The products are almost same, they are similar. There are large number of buyers and sellers, and there is a free entry and exit of your free entry and exit of your products, or you can say of the organizations or suppliers. In this market there are homogeneous product. The products are one of the same, almost of the similar nature, similar kind, and there are large number of people who are dealing in this. Number of customers are higher, as well as buyers are also in large numbers. Then we have monopolistic market, a market where there is full control over your supply. There is no competition. You are the individuals, or you have a monopolistic role in that market. You do not have any substitute. There is no question of substitute for a product. It is a monopolistic product, and you being a supplier, you being a organization or company supplying the product, are the price maker or decision maker for the price. So in the competition market, the pricing is decided by the market, by the supplier, not by the supplier but by the customers or consumers, because there are large number of people from whom you can buy or sell this product. But in monopolistic market, as you do not have any substitute, your product becomes a you can say a price maker, a price decision maker. Then we have monopolistic competition. Monopolistic competition is where there are large number of firms, there are large number of products, but these products are not homogeneous as they are into perfect competition. There are differentiation products, there are various products, different kind of products what we have over here, and there is huge expenditure on your product advertisements as well as your selling cost. Because what happens over here is your products are not homogeneous, they are different, but your products are giving they are serving the same purpose to the customers, and because of that reason, when they are serving the same purpose to the customers, you need to aware the customer about your product which is different from another products. And that is the reason why this differentiations products are been considered under monopolistic competition market. Large number of firms or organizations or companies who are into this product, and they are a huge expenditure what we do. In the oligopoly market, again there is an interdependence of there is an interdependence of about you. So basically what happens in this market is there are few number of sellers which are interdependent, and there are free entry and exit barriers. So there is no, you cannot say as a free entry and exit, but there is a barrier on entry and exit, because everything is interdependent on from one organization to the another organization. So as it is interdependent with another one organization with another organizations, it becomes difficult for someone to enter in the market and exit in the market, and that is why it has a barrier. But in the competitive market, it has a free entry and exit. Anybody can come, they can deal with their homogeneous product, they can sell in the market. Over here the organizations are interdependent, so the moment you come with some other product, you're not that easily you can enter into the market. As well as there are few sellers, the spelling is SELLER, so there are few sellers over here, and they are also all interdependent upon their product organ. So this is a theory portion of how the pricing will be, what are the different market scenarios or market condition is. Now what should be your principle of product pricing, right? So what is the question would be, what is the principle of product pricing? So pricing can be done by two ways. Number one is price customization and price sensitivity. While deciding the prices, you need to understand the customization. What is your product line? So what are the principles? See, understand, this is one of those theory questions where a lot of students gets confused in exams. They are not asking methods of pricing, they are asking is principle for pricing, right? So what the principles that you should follow while you're deciding the pricing of your product, and on this basis of this principle there are two understandings what you should give. The first is price customization, the second is price sensitivity. How will you customize the price? How can you customize your product or the pricing of the product? That is on the basis of your product line, on the basis of your customers past behavior. How was the behavior? So today if I am launching some product, I should have the principles. The principle should be, what should be my pricing? It should be decided on the basis of customization and sensitivity. How should I decide customization? It should be on the basis of how the behavior was of customers in the past, how the product line has been doing till now, what were the demographics what we have followed, in which areas, in which zones, or in which situations the pricing has been done, and the time differentiation. What was the before, when you the time differentiation is at different zone and different areas in different demographics, you put a different time areas or time differentiation product. So these are the things that you do consider while you're customizing your product of the price. How the price sensitivity plays role, what are the how the price changes. Like if for example I launch one product, instead of 15 I want to keep it 12 or 18, so how should I sense, what are the sensitivities which will affect that price, what are the factors, what are the areas that are sensitive to my price, because of which my price may change or I may fluctuate the price. The price has unique value effect, we are giving some unique to the customers, our customers get an unique options or unique satisfaction from our price. Substitute awareness, we provide them that about the substitute product, what is the awareness, what are the substitute products, how our product is working, what are the best things that our product can deliver, what are the different what is difficult comparison, you can compare your products, or what is the difficulty about their product, or you can do the comparison about those products. Shared cost, what are the costs, how the cost has been shared, how the product has been manufactured, while manufacturing the cost, what are the costs that you have incurred, how would that be distributed, if you are giving some kind of combos or two products mixed together or three products mixed together, how will this work, as well as what are the end benefits that will be given to the customers, how the customers will be benefited at the end, and then total expenditure, what is your sunk investment that you've done, what is your price quality that you've done, and what are the inventory effect that you've done. So inventory effect, what it is in a product, what are the sunk expenditures that you have done, you have already incurred, so how now that will be considered or not, how these products is, whether they are relevant or irrelevant, what is your total expenditure, how your sensitivity should change, how you should decide the price, and all those relevant factors, this key point should be considered while for principles of product pricing. So when I'm doing a product pricing, what are the principal areas I should focus on is product price customization and price sensitivity. Price customization depends on four things: your product line, customers past behavior, demographics, and differential time zones, right? Your price sensitivity depends on what is the unique value that you are offering, how is your substitute awareness, what is the difficult comparison you have, what are the end benefits, what are the sunk cost, what is the investment quality, price quality, and as well as your inventory effect. Then after that, one more is what is pricing methods. So we have three kind of pricing methods. A pricing method, what does this mean now? Understand. Pricing method means that how will you decide the pricing of a product, what method will you follow for your pricing of the product. So now you have three options, whether it is for competitive, it is for cost oriented, or it is value based pricing. What kind of pricing method that you want to follow. If you follow for your competitive pricing, now when there is a competition pricing is like if I am launching some product, or if we are launching some product and there are already homogeneous products in the market, what kind of pricing we will set in basis of that competition. So in that competition market, when I am going for method, the pricing method, there are two things again which I need to focus. Can I go with going rate or sealed bid? There are two things that you have. Going rate method. What is going rate method? You keep the price according to your homogeneous products or according to your product pricing, and that is average level charged by the industry. Say for example cell phone industry, right? So when there are Android phones, there are various products, or there are various kind of companies who are giving you an Android phones, right? So Vivo, Oppo, you have Micromax, you had this Lenovo, you have OnePlus, you have Samsung, various kind of. So when you're entering that kind of competitive market, then your product pricing, how will you decide, is on a going road basis. So what is the average market rate of this product? On that basis, even we will decide how our product will be pricing will be done. So this is the method. So when I'm going for method, before this what we discuss is principles. So when I'm going with the method, there are three methods what I can follow. I can go on competition, I can go on cost, I can go on value based. If I go on the basis of competition, I have two things. One is going rate and one is sealed bid. What is sealed bid, sir? Base bidding link like closed auctions. Like, so when you have auctions over there, for example, you have to provide some bidding for some purchase of some products, or you have to seal some deal with the organization like quotations deals and all those, then in that case you provide such a price that your price has an average of all, considering your competitive pricing or your competitive quotations, and accordingly you bid in such a way that the bid gets closed by your pricing. So in that case you cannot go by the most lowest pricing, nor you can go the most highest bid, but you should decide such bid where your pricing or where your pricing decision based bid is comparatively average to the market. Then we have cost based. So in cost based we have three kind of cost based. One is full cost, variable cost and variable lump sum. What is full cost? Full cost considers of variable cost plus fixed cost. So when I'm going for cost based methodology, what kind of cost base should I follow? Whether I should consider full cost, or I should consider variable cost, or I should consider lump sum. Now what is full cost? First what I understanding is that is variable cost and fixed cost. So when I am deciding a pricing of my product, I will take full cost of the company, and on those basis of full cost I will decide the product pricing. That full cost product pricing what I am talking about may be of your will be of variable cost as well as fixed cost, correct? Then we have is variable cost. What is variable cost pricing that you put? Variable cost is only those costs which are changing with the change in product, only that variable cost you will consider. So in this case fixed cost is not that you are considering while deciding the pricing of your product. Why, sir? Because fixed cost, as we have understood, it is a sunk cost, it is apportioned to the product, it is not relevant for deciding your pricing when you enter into the market. Majority times fixed cost, what you when you enter into the market, to keep the lowest price possible, you go for variable cost. What are those variable costs? The cost which you have incurred to manufacture, the cost which you have incurred for that product, directly for that product, and all those costs should be recovered, and that is the reason why variable cost is considered. Or variable lump sum is you go for a product price where you consider lump sum price of variable cost as well as a few portion of fixed cost, and accordingly you decide your price. So variable cost is the least price that you can offer. Total cost is where you cover all your costs, that is variable cost plus fixed cost, and lump sum price is you can offer the price where there is somewhere exactly not the variable cost but around it. That is the cost based orientation what you can go. Second is value based. So there are two things in value based. One is true economic value and one is perceived value. What is true economic value? It is the cost of next best alternative plus value of performance differentiation. So the next best alternative, what is the value addition, or what is the economic value that you are providing to the customer? It is the cost of next best alternative. What is the next best alternative available in the market? On the basis of that you decide your pricing, and plus your performance differentiation. What is something different that you have been providing? Say for example, if if you want to purchase a refrigerator, then we have various companies like IFB, Haier, LG, Samsung. We have various companies for which we can go for refrigerators, right? So what is, if I want to give the best value oriented pricing of my product, then in that case how we will decide? We will decide what is the next best alternative product, or what is the best next company which are offering product, and from that price plus what is the differential that I am giving in my product, and that is the reason why you decide. That is the reason why there is a difference in pricing. Say for example, OnePlus in cell phone industries, right? OnePlus has a different pricing model than Vivo, Oppo and your Micromax or Lenovo and all those. Why? Because OnePlus decides first what is the best alternative available, and what are the best features that OnePlus is offering compared to other alternatives. On that basis, what is the extra value that we can put? Second is perceived value, value that customer understand this product delivers to it. Perceived value means you can understand that okay, this is something where this product will definitely be delivering, or this is something where a customer already has a mindset that this much amount or this product will definitely have a value in the market, or this is the customer satisfaction what we will definitely have. Say for example iPhones, right? So when you launch an iPhone, a new iPhone is launched, customers already have the perceived value that on the basis of the past performances, on the basis of their past value to the customers, this will definitely put this pricing in the market. So when it comes to pricing method, there are three ways what the pricing method can be decided: competition, cost based, and value based. When it comes to value based, there are two things: economic value and perceived customers. Cost based, three things: total cost. Total cost includes variable plus fixed, variable cost and a lump sum variable cost, whatever you put it as. And when it comes to competitive market, there are two things: going or sealed bid. You go on the basis of the competitors, what is the alternative pricing what they are charging. So on the average industry price that you charge on the going bid rate, so that you enter into the going market, or you go with the bid price where you put a quotation where your bid gets finalized. Then what we have is the next is innovation. So there are two kind of pricings what you decide. One is pricing in recessions, one is pricing below marginal costing. There are two situations where how the pricing would be decided, that is the question. So whenever there is a recession period, right, you go for sales above marginal cost but below total cost. What is above marginal cost, what is below total cost? See, there are three kinds of pricing model what you can set. Number one is at a marginal cost, above marginal cost but below total cost, and total cost above total cost, right? So whenever there is a recession period, you utilize your labor and plant and efficiently machinery, you decide such a price where you are above marginal cost but below total cost. What is your total cost? As we already said in cost marketing, total cost is what? Total cost is, that is variable plus fixed cost, right? So I have to make sure that all the variable costs which are incurred in the product for the manufacturing of the product are recovered, and on the basis of that recovery of that price, or on the basis of recovery of that, what I decide is I decide a minimum selling price of my marginal cost. But above marginal cost, there is some portion of contribution that we keep to in the recession period, but we do not go about total cost. We make sure that we utilize our labor and plant efficiently, effectively, as well as we our brand name, our product pricing, or our in the duration of this recession period, our product image should remain same. It should not be in the recession period, it should not be fade away, or it should not be out of the market scenarios. And that is the reason why we decide this pricing on the basis of, in this basis of recession period, there is something above you understand marginal cost but below total cost. But when you decide below marginal cost, in the case of below marginal cost means you are selling a product below your variable cost. That means you are incurring negative contributions. When you go that negative contribution is done when you want to popularize your product, right? So in the initial phase you want to popularize your product, you want to make sure that your product gets popular in a way it comes to customers come to know about your product. Secondly, the nature of the product is perishable. So if I am not selling this as of now, it will get perished, and because of that I will eventually lose the whole sales price of the product. So to make sure that we generate a sales, we generate a revenue even at a nominal below marginal cost or at nominal price, we have to make sure that we sell this product. Third is accumulated stocks. You have a lot of stocks, a lot of stocks are available but the demand is low, or the awareness of the customers are very low. So to make sure that this accumulated stock gets sold out, what we do is we provide it to the customers, we give it to the customers at a price below marginal cost at a negative contribution. And second is to complement some other product. So when there are some other products to whom you are complementing your product, to make sure that you are, like say for example the complementary is like providing ketchup with some food items, right? So you're complementing that product. In that case you may give it in a below marginal cost, that ketchup pouch or what you're giving it, because in that case my main product will get complicated and the demand of main product will increase, then automatically the customers will ask for the complementary product itself. So there are two things that in the innovation you should understand. Pricing under recession, you may go above marginal cost but below total cost you should go, and when you should go for pricing below marginal cost when there are four conditions. In these four scenarios you should go for below marginal cost. Now this kind of case study questions what we have solved in our class, right? So when we were understanding this theory, we have solved case study questions, we have solved comment, interpret, analyze. What would you suggest to the management kind of questions, how the pricing should be set, how the considering the market scenario, what should be your understanding for the pricing. All such kind of understanding questions what we will cover over in this topic can be asked in your examination hall. Then we have is there are pricing methods. See, now understand, we have already understood pricing methods like in competitive market how it should be, what should be your value based pricing, what should be your cost based pricing, right? But there are again different two methods. What you need to understand is one is skimming pricing and one is penetration pricing, right? So for skimming pricing and penetration pricing, what you need to understand is whenever there is a skimming pricing model, let us understand now. So there are two, I am not saying this pricing method and that pricing method are same. See, that is on the basis of the scenario of the market or how you want to decide the price of a product. Whether you want to decide on the basis of the value of a product, whether you want to decide on the basis of competition of the product, or whether you want to decide on the cost of the product. How will you decide your cost? But once you decide the factors, once you decide that methodology on which value, economic or competition will offer your price, then we come to this portion of pricing method. How will you set your price? Whether you will go with skimming or penetration. There are two pricing models what we have. Skimming is high price at the initial stage of product cycle. It's like we have already seen product cycle in strategic cost management introduction and that chapter life cycle costing, right? So at the initial phase, if you decide higher price, it is known as skimming pricing. You are skimming all those price models and you're going on the highest price in the initial phase. And then in that case, inelastic demand you have and your cover the cost of production. So what happens is, say for example, when you decide skimming products, skimming pricing, launch of a cell phones, launch of your automobile industries, right? In the initial phase, the cost is very high. Then gradually the cost keeps on decreasing. This means that there is something absolutely different that this product is offering to you. There is something which none of the product has offered till date, and that is the reason why I am entering the market with the highest price in the market. So my all cost, everything in that cost is covered in that phase. First, there would be inelastic demand in the market. Considering the scenario, considering the situation, the pricing would be higher in the first and then in the initial phase, and then it will gradually keep on decreasing and lowering down. But there is another pricing is penetration. I want to penetrate, we want to enter the market with the lowest price possible. So we keep lowest price in the beginning, in the early phase, so that we get in penetration in the market. Once we penetrate, we have elastic demand. The demand is as per the market demand is what we have, and we treat our competitions, we go in competition with our product, other competitors products, and accordingly we stand in their competition with them. Then once the awareness is understood, customer satisfaction is achieved, customer behavior is known, pricing models are understood, then we gradually increase our pricing. So there are two ways how you can enter the market with the pricing. That is, one is skimming pricing and one is penetration pricing. When it comes to skimming pricing, in skimming pricing what happens is you put highest price in the beginning and then the price keep on reducing. Three important points to understand is it has inelastic demand and it covers cost of productions, right? The whole cost of production, huge investments, huge advertisement cost, initial phase research and development cost, all thing is recovered at the initial launch period itself because of high pricing model. Like cell phones, right? So iPhones, when you launch an iPhones, right, a new iPhone model is launched, the pricing is high at the initial phase because all their research, advertisement, development cost, everything is covered in the initial phase of that product itself, and then the price keeps on lowering. But when it comes to penetration pricing, the first scenario is to penetrate the market, to enter the market with the competition. So the lower pricing at the beginning, you enter with the low pricing, then there is elastic demand over there, and over there you treat your competitions, you compare the competitions as mean what they are offering, you are offering the same to the different customers, right? Then we have strategic pricing of new products. So there are three kind of strategic pricings that you can put, that is revolutionary, evolutionary and me too. Understand now what is this. What are the strategic pricing of new product? How do you strategically decide about the pricing of your new product? It may be revolutionary, evolutionary and me too. What is revolutionary? Totally new products can create its own value. Say for example your iPhone, right? So the revolutionary price, that is what strategically you decide. It was never been done before. This is for the first time. This is a new product in the market. It is for the first time happening, and your own value you have. Say for example, in, if I understand, in confectionery industries, one of them was Kinder Joy, right? So Kinder Joy was something, a revolutionary product that they had introduced. McDonald introduced a revolutionary product of Mac meals in the initial phase. So they have their own customers value, their own kind of customers. They do not compete with the other products in the market. They are absolutely revolutionary to the market, something what they are offering which nobody is offering till now, and that is the reason why they have their own new, totally new products. They create their own value. This is strategically how you enter into the market. Next is evolutionary. Evolutionary is you upgrade your own products, right? You upgrade your products with the same new technology, with the help of new additional characteristics. Like for example, the dairy milk did. The you can note these examples also. In revolutionary we had Kinder Joy, as I said. In evolutionary you have dairy milk silk, so you are upgrading your product. Dairy milk silk, then we have fruit and nuts, we have crackles, we have almond, roasted almond, cashews, all those kind of upgraded products. So that is a evolutionary pricing what you set for your product. That is a strategically you decide that to give a change, to give an evolution to the price, to give an evolution to the product. This is what you do, upgraded version of existing product with few additional characteristics that you give to your customers. Like then is me too. It is me too is a copied cheaper version of evolutionary product. So whatever is the evolutionary product that we have, right, like dairy milk silk, dairy milk, this crackle, and all those cheap companies or local vendors or anybody like that who gives this, copy their ideas and then they give it to the market on the basis of their evolutionary product, and they copy their pricing, or they copy their cheaper, not exactly pricing, their pricing are cheaper, but they copy all the characteristics of evolutionary product, because revolutionary cannot be compared or competed, but evolutionary can be. So I can give you one more example is, you can put it in this way. Revolutionary is something like iPhones, right? And Samsung and OnePlus comes in the evolutionary models, right? But the phones like Oppo, Vivo, all those, where they copy the features of these products and then they provide, like Micromax, Lenovo, and all those stuff income. So strategically there are three things to understand, that is revolutionary, evolutionary, and me too. How do you decide your pricing strategically? How do you decide your pricing on the basis of methods? So skimming and penetration what we have. Next what we have is, for pricing policy, price adjustment policy, pricing of services. What is a price adjustment policy? How do you adjust your price? That policy, how you decide? So we adjust our price on the basis of distributors discount, quantity discount, cash discount, geographical pricing, and price discount, right? So what are the price adjustments that a company may do? Company may change their prices according to the geographic pricing. Say for example, I'll give you one of those example. For few products, when you go for confectionery, in this state this is available at 25 per unit, but in other states it is available at 27 per unit, because geographically pricing, that is what adjustments you do, right? You do on the basis of quantity discounts. If you buy in bulk, what is the quantity that you get? You do on the basis of distributors discount, the distributor model what is being implemented. Cash discount, if you buy it in a cash you get a discount as of now. If you buy it in 2 days you get this discount. If you buy it in this week you get this discount, kind of sales what we have. This is what price adjustment policies. So what kind of adjustment in the prices can be done, and that can be done, how it can be done, that is what we decide here. Pricing of service, like you already know, as you all are getting chartered accountants, you are in CA final. So when you're providing your services, how you decide the pricing of your services? That is our number one is distinct pricing for each customers. Like we our all our clients in our practicing firms, when you go to practicing firm, when you're in your articles you have observed, all other clients have different kinds of pricing models. You cannot decide one single price like MRP for each and every. It depends on client's complexities, the time taken, client availability, client awareness, data available, clients, ERP systems, and all those things. So you decide this is distinct from each customers. Second is you have is intangible cost like goodwill. You have your own time cost what you're giving to the client, your own time what you're devoting to the client. And the third is regulation in price, what the changes in price, the market scenarios of the price, the customization what you do for the price, and that is how the pricing of services has been decided. So what are your adjustments in the pricing that you do, and that is what has been decided over here. Now further we come to our next chapter, revision of transfer pricing. So till now whatever we have understood how to decide the pricing policy, what should be your pricing method, how the pricing should be decided, what are the things that you should take care while deciding the pricing, what are the methods that you should follow, what are the situations of market that you should be understood. Now when it comes to transfer pricing, there are three phases for which your transfer pricing has been decided, and the transfer pricing is always of two standards. One is minimum transfer price, one is maximum transfer price. In our classes when we were doing this, for all the students who are watching this video who are our students, for them it would be very easy to understand this, that what is meaning of minimum transfer price, what is the meaning of maximum transfer price. But for those students who are new to this, I'll explain to you also, a short explanation I'll give it over here. Minimum transfer price is the buying division. The buying division would always there are two divisions what you have. One is the buying division, one is the selling division, right? Or the selling division would always understand what is the minimum transfer price what I should be selling it. So I should not sell anything below this. And what is the maximum transfer price? Maximum transfer price is from the viewpoint of the buying division. The buying division decides that I will not pay anything maximum than this. So we decide the transfer price between the minimum and the maximum. So how you decide the transfer price? What should be the minimum price charge? Always think minimum price should be from the viewpoint of the selling division, because I will not sell below this price. As we have already done in the pricing model, what we understood is how the pricing will be decided. So we will never sell below this pricing price, or we will never provide below this sale. That is known as minimum selling price what we do. And the buying division will always think from the viewpoint of what is the maximum price that I can pay, because this product is available in the market. I have to sell my own product in the market to get the intermediate product from the another division. What is the maximum price I can pay on the basis of my budgets? So there are three situations when there is no idle time exists in the transferring department, when idle time is more than the internal demand, and when idle capacity is less than the internal demand. What is the maximum transfer price and the minimum transfer price will do? Remember, this chart is one of those very important charts for your transfer pricing chapter. Understand, when there is no idle time capacity, what does this scenario means? This scenario means that I have no idle capacity in my department. All the goods that I am manufacturing are being sold externally to the market, or they have an external market demand. So there is no question of idle capacity, or there is no question of idle time in my department. In that case, if I am selling any product internally, then I am not able to fulfill the demand of external market. So the minimum price would be the market price what we have. The market price at which we are selling, that will be the price. Maximum transfer price will be the market price of what we are selling. We cannot go below this. The maximum price is the market price. We cannot go below this. What is the minimum transfer price that you will sell? Minimum transfer price is the variable cost of manufacturing plus the contribution lost. Now what is the contribution loss, sir? When there is no idle time capacity, what is happening is, if I am manufacturing a product, I am not selling in the market, but I am giving this product to my internal department, then I am losing the share, I am losing the contribution of external market. And that is the reason why, as I am losing the contribution of external market, I will make sure that when I am transferring this to the internal department, I will always understand that my contribution loss should also be recovered from internal transfer pricing. So when there is no idle time capacity available, what we shall do is, in that case, my variable cost, minimum transfer price variable cost plus contribution foregone. Say for example, you were giving this product in 44 rupees in the market. The market price of this product or your competitor is providing 45 rupees in the market, right? So in that case, this 44 is your selling price in the market. Your variable cost is 40 rupees of manufacturing this. So now when I am selling this to my internal department, I cannot sell it at 40 rupees because I have no idle capacity. All the productions what we are doing, all the demand what we are fulfilling, all our market, that there is no idle capacity. So if I sell it in the market, I will get 44. I will generate 4 rupees of contribution. But if I am not selling in the market and I am doing internal transfer, I am losing that. So my transfer minimum price what I can offer is 44 rupees. The maximum price, the buyer, think maximum price will be always on the view from the buyer. The buyer will not pay beyond market price. What is the market price? 45. A substitute product or another product is available at 45. So he will not sell or he will not buy be above 45. So maximum market price is 45. Minimum price what you can offer is 44 when there is no idle capacity available. When there is idle capacity more than the internal demand, in that case what is happening is your market demand or your demand is fulfilled, but still you have an idle capacity, and that idle capacity is more than what the internal demand is. Say for example, my capacity is of 10,000 units, my market is of 5,000 units, and my internal demand is of 4,000 units. Then in case first I will fulfill the market demand, and the remaining 4,000 unit what the internal demand is, I will manufacture there for them and I will transfer to them. In this case, anyways, if you are manufacturing any of the product that is beyond your market demand, only variable cost, that is what you're incurring, because first out of the capacity of 10,000 you are fulfilling the market demand of 5,000. That is what you have done. Now you have idle capacity of 5,000. Out of the idle capacity of 5,000, 4,000 is your transfer division demanding. So 4,000 can be transferred to them. You can definitely transfer 4,000 to them. At what price? At a variable cost, because there is no question of contribution lost or forgone. And what is the maximum price that buyer can offer you is, the maximum price what buyer can offer you is the market price what he has. Always remember, the maximum price will never be above market price. Why, sir? Because if the product is available in a market, if the product is available in the market at by some another competition or as a substitute product, why will a purchasing department, a buying department pay you extra beyond that price? So your maximum price will always be a market price. Minimum price, there are three situations which you understand. Is there idle time? Do we have a sufficient idle time? Yes, then variable cost. Do we have idle time? No, we do not have idle time. Then variable cost plus contribution loss, that is forgone. The third situation is when idle capacity is less than the internal demand. Now, what happens in that case? Understand, very important of this, and that is why we have written is average of this. What is this average, or why we are understanding this? Suppose your capacity is of 10,000 units. I repeat, your capacity is of 10,000 units, right? What is happening is you are providing or you are selling in the market of 7,000 units. Now, your internal market demand is of 5,000 units, right? So once I fulfill my demand of market, I am left with idle capacity of 3,000, but my internal demand is of 5,000. I cannot fulfill the demand of 5,000 because I have only capacity available of 3,000. Remember, our first example was your internal demand was more, right? Your capacity was more than your internal demand. So in that case, we said that there is only variable cost what I'll be providing. But when your internal demand is more than the idle capacity, in that case, what will happen? See, first of all, I will fulfill the demand of 7,000 units in the market. But if I fulfill that, my internal demand of 5,000 units cannot be fulfilled because my spare capacity available is only 3,000 units. And that is the reason why now what shall be done? In that case, what you should be do is, your internal demand is 3,000. To fulfill the internal demand of your internal demand is 5,000. To fulfill the internal demand of 5,000, you have to lose contribution of 2,000 units of external market what you were selling. Sir, how do we get 2,000 units of external market we were selling? Because in the external market you were selling 7,000 units, but if you fulfill internal demand of 5000 units, you can only sell 5000 units in the market, and that is the reason why you will lose contribution of 2000 units from the market. In that case, your idle capacity for first 3000 units, what you are giving it to your internal product, it will be the variable cost. Your for this 3000 units, the cost will be variable cost of transfer price, what you will decide. But for 2000 units, what I am giving for after 3000, the extra, the more than 3000, the 2000 is what I am giving to internal department. For this 2000 units, I am losing a contribution of my external market demand, and in that case, capacity sacrifice of 2000 units, what will is variable cost plus opportunity cost. In this case, for this 2000 units, what I am talking about over here, it comes to the scenario of when no idle capacity is available. Understand, this third situation is combination of first two. The first says that there is no idle capacity available, the second says that there is idle capacity available. But when there is a situation of both mixed together, idle capacity available is 3000 but internal demand is 5000, then I will give 3000 units at a variable cost. But for the 2000 units, what I will do is I will give a price of the market what I am losing, so variable cost plus contribution foregone. So this is a price of 5000 units that I will give it, and the average price will be calculated accordingly. One of those very important with idle capacity, in our material specifically we have a good number of sums on this concept. How do you decide the pricing? Because the opportunity, the contribution foregone, the opportunity loss, that is what also to be considered when you're giving a transfer price to your internal department, losing a contribution or losing a contribution of market demand. But when there is no question of market demand, spare capacity is available, minimum transfer price will always be the price at which the variable cost is incurred. But the thumb rule is maximum transfer price will always be the market price. Very important chart. This chart will help you a lot in the questions of what should be the transfer price that is to be decided from the viewpoint of selling department, from the viewpoint of the buying department, and that is the reason why this is what we have covered in our revision. Further, next what we have is AJ's remark. There are this important point that you need to understand. Opportunity cost based transfer pricing. What is this? See, this is the third situation what I said, a very important situation. On basis of that, what I am saying is, it is advised that for decision making purpose, a transfer price should be one which is based on marginal cost, that is incremental cost plus cost of goods plus any opportunity cost of the firm as a whole. So any opportunity cost what you are deciding or what you have, that is also to be considered, as well as your cost of goods is to be considered. So marginal cost plus opportunity cost of a goods as a whole for not being able to use them in the best possible way. Where goods are transferred internally by a supply division which also has an outside market of its product, right? The optimum transfer price is one which is one based on opportunity cost. The opportunity cost identified here as maximum contribution foregone by the supply division in transferring internal rather than selling goods in the open market. So this is what the situation what I was explaining. Now again I'll give it with this example, with the same example what we discussed detail. 10,000 units your capacity is, your market demand is 7,000, your internal demand is of 5,000. I cannot fulfill the internal demand of 5,000 because my spare capacity is only of idle capacity is only of 3,000 units. In that case, to fulfill the 5,000 units demand, what I need to do is, first 3,000 units I can supply them because I have a spare capacity available for, but after that 3,000 units, from 3001 to 5,000 units what I am supplying internally, I will lose the market, I will lose my market share, I will lose the contribution which I was earning in the market, and that is why it is known as opportunity cost, right? Example, my variable cost of production is 40, my selling price is 44, but the market selling price is 45 of the substitute product or from the competitive products, then in that case maximum price what we can set is 45, right? That is the maximum price, but minimum price I can set is 40, that is the variable cost. But if this product has a market demand and I am not giving in the market, that means I am not selling at 44. I am losing a contribution of 4 rupees as I am not selling in the market and I am giving it to the internal transfer, and that is the reason why this is called as 4 rupees is called as contribution foregone opportunity cost, a cost or a loss what we have done of an opportunity of selling at 44 in the market, and that is why we call it as opportunity cost. Maximum contribution foregone rather than open market. For this reason, a transfer price equal to market value, that is our market value less selling cost, is often an opportunity cost price. Transfer price can be reached, perhaps negotiated by, there are this is what we need to understand is recognizing the level of output, sale, external sales and internal transfer that are best for the company as a whole. So what is your recognizing the sales, recognizing the level of output, what is the level of output that you have, what is the external sales you have, what is the internal sales you have, do we have spare capacity or we do not have spare capacity. If we have spare capacity, is it able to fulfill all the demand of intermarket, or I have to somewhere compromise or sacrifice my external market. Arriving at a transfer price that ensures that all division maximize their profits at the same level of output. The transfer price should therefore be such that not all more profitable opportunity for individual divisions. This in turn means that opportunity cost of transfer should be covered by the transfer price. The effect of opportunity will be different in different situations. So in perfectly competition market, now different opportunity cost for different situations. First of all, we understood what is the opportunity cost, what your opportunity cost means. But how will you decide the opportunity cost? In perfectly competitive market, that is all products sold internally can be sold externally, right? My all products can be sold externally. In that case, the pricing will be variable cost plus contribution margin. That is what we have foregone. So transfer pricing will be variable cost plus contribution foregone for those number of products. Then in case of slightly imperfect market, where market transfer price technique will be variable cost plus contribution will be equal to adjusted market price, that is prevailing market price less economics arrived by selling internally. What is this, sir? Can you explain? See, when there is slightly imperfect competitive market, what does this understanding is? That if I am selling this product in the market, I have to incur 5 rupees sales and distribution cost. I have to incur 5 rupees of cost of the price what extra I will do it in the sale. So what happens is, if I do not sell it in the market and I sell it in this scenario of my internal transfer, then I am saving that 5 rupees cost. So that cost is not to be considered. Variable plus contribution margin only will be considered. But which contribution margin? The after that 5 rupees price. If you do not consider the 5 rupees price, what would be your contribution that you need to consider? For example, your variable cost is 80, your market selling price is 100, but to make it sellable in the market, you need to give a, say for example, 6 rupees of your sales commission or your selling cost what you incur. So in that case, my variable cost will be 80 and contribution will not be 100 minus 80 20, but contribution will be 14 rupees what we get, that is 100 minus 86. So we will put a transfer price of 80 plus 14, 94 here itself. But when there is no extra selling cost that you are incurring, you will sell it at 80 plus 40 20, that is what 100 what we have. In perfectly competitive or slightly improvement, most products are sold externally. Products sold internally do not have a market price. If they are sold internally, they do not have market price. Production capacity used to produce internally sold product can be used to produce externally sold product. Transfer price technique, variable cost plus contribution margin equal to Phantom market price. This reflects the opportunity cost of producing the product for an internal user. Now, there is a market where you have an internal demand and you have an external demand, right? So now there are two products. Your internal demand is of product A and external demand is of product B. So to manufacture A, right, you are losing a contribution of B. In that case, your transfer price will be variable cost of A plus contribution foregone of B, because your A doesn't has a market demand but your B has a market demand and your capacity of production is limited. So you decide to produce A, that means you're not deciding to produce B, and if you're not producing B, you're losing the market of B, and that is the reason why it is known as It is a price where variable cost plus contribution margin of B that is to be considered. Further important comments, the question on transfer pricing techniques, the question on transfer pricing are often lengthy and contain a lot of detailed description. This is what I have told in my classes also when I was teaching this chapter, that transfer pricing questions are lengthy. There are a lot of informations given, a lot of kind of different transfer price, different variable cost, different product, different divisions, and all those subsidiaries and parents and all those kind of words are being used in those. So when you're reading this, understand a particular situation with reference to which a particular solution has to be thought about. Various alternatives have to be evaluated and the best one is to be proposed. For this purpose, contribution related to different alternatives should be considered and the best alternative has to be suggested. The questions where you have been given with suggest, the questions where give an alternative. Say for example, there are 4 divisions, right? So in that 4 division, what is the question that they are asking? What is the relevant information for you? What is the relevant suggestions that you can give? Understanding this is very, very important. As per the past questions, as per the students experience, as per my teaching experience, what I'm talking about is a lot of students have gets confused when there is a question of transfer pricing. So understanding there is a lengthy question, but you split this question into various parts, into various paragraphs. Evaluate each paragraph first, understand each paragraph, understanding each paragraph and connecting with the another paragraphs of the values of the data will help you eventually that exactly what they are asking, what are their expectations and how you can suggest them. That is what you need to understand. So this is a specific comment in examination, all you should take care while you are appearing in this question. When a situation arises, conflict of interest, when there is a question where conflict of interest arises between the 2 divisional heads, 2 divisional managers, 2 departmental heads, in that case always understand your transfer price should be on the basis of goal congruence. That is, your overall company's interest should be the liquidating factor. So say for example, there is a conflict between division A and division B and you have to decide or you have to give a suggestion answer. In that case, you decide such price which is in the interest of company. Goal congruence model is to be observed or goal congruence model should be achieved. On the basis of that only you will decide a transfer price. So even you should not be confused. Your answer should not be a diplomatically like division A should have this and division B should have this. No. In that case, you should make sure that you decide the answer on the basis of company's overall interest. Further, when a transfer price is suggested, it should kept in the view that the price should be motivational to the division managers, right? As I said, anything you cannot go below your variable cost, anything you should not go above your market price. So it should be motivational to the division manager. It should provide a reasonable measure of performance evaluation, as we have already seen in performance evaluation chapters. Various methodologies you have to decide your performance of your managers, performance of your divisional heads. So that is very important, and ensure that divisional autonomy is not undermined. That is, your divisional responsibility or single transfer price is not undermined, and that is also been achieved in all the scenarios. Next, coming to is in fixation of transfer price, it is pertinent to consider how do you decide the transfer price. See, I repeat, in transfer pricing questions, there are few things which you need to understand in depth and there are few things which you need to understand like minimum price, maximum price, how you will decide the transfer price, what is the opportunity cost. While deciding the transfer price, you should always understand what is the market, what is the competitive market, how you should be pricing be done in this market, what is the market price available, at what the substitute product is available, your product is available at what price, your homogeneous product available is at what price, your substitute product is available at what price, and all those properly adjustments of selling price, interdepartmental pricing, sales to the market price, and all those adjustments should be done, and accordingly your fixation of transfer pricing should be done. As I said, if I am doing it in the internal transfer, I am not incurring a cost of sales, I am not incurring cost of distribution expenses, I am not incurring a cost of commissions or all such kind of. So such pricing should also be considered, such factors should be considered while you are deciding a transfer price. Capacity constraint for supplying division is one of those very important factors that you should consider. So while deciding transfer pricing, what are the factors that you should consider is one of those are very, very important. While deciding fixation, always check what kind of market it is, What is the market price of your substitute product? What is the cost that you are incurring? What is the additional cost that you will incur if you sell it in the market? What is the savings that you do if you transfer in the internal market? What is your capacity available? How is your capacity can be utilized? Do you have idle capacity, spare capacity or not? That is what you should evaluate accordingly. It transfer price fixes marginal cost for supplying division. As I said, minimum transfer price will be decided from the viewpoint of supplying division. Maximum transfer price will be set from the market on the basis of buying division. This does not motivate the manager of supplying division. For this reason, the likely share of profit of final product should be suitably distributed between receiving division and supplying division of intermediate product. It represents best compromise in the transfer price, that is goal congruence. Now we have done few questions, and while doing these questions I had specifically mentioned this point, but for this revision when you're doing, I'll explain it this again to you. Is, say for example, the final product is sold in the market at 200 rupees. The division A is manufacturing this product as suppose 80 rupees. The cost of division B is again at 80 rupees. That division B will incur the cost. So division A is manufacturing cost is 80. They are transferring this product to division B. Division B is incurring additional cost of 80. Total cost is 160 and the market price or the sales price is 200. In that case, if the transfer price you decide is 80 from department A to department B, the manager of department A will not be motivated, will not be happy with this transfer price, because the profit of because the cost of division B would be 80 of his own departmental cost plus 80 is of transfer pricing, so 160, and the final product is sold at 200, so 40 rupees profit or contribution is earned by division B. In that case, a motivating factor is shared profit. Shared, the word specifically what you have used, if you understand, is likely to be share of profit of final product should be suitably distributed between the departments. So in that case, the profit should be divided on the basis of cost factor. Over here 200 is the selling price, 80 rupees is the cost of your division A, 80 rupees being the cost of division B. So in that case 160 comes to the total cost. 40 rupees of profit should be divided into two divisions on the basis of their cost, that is 80 is to 80, that is 1 is to 1, that is 20 is to 20. So the transfer price what you need to decide should be 100 rupees on the basis of your transfer, that your division A also gets motivated, your division A manager is also motivated, and the profit is shared to them as well. As if supplying division has incurred overtime, it should be consumer determined transfer price. If you remember, we have a question of overtime analysis where exactly those who have not done from our material, there is one question in our material where we have mentioned that if this demand is to be for internal demand, overtime will be considered, and extra payment specifically when in that question we given is the labor will be paid 1.5 times than the normal, so that 1.5 times of the normal what it is giving, half the price what you are paying them extra should also be considered while you decide transfer price, and ultimate objective is to increase the group profit as a whole. So special care should be taken. See, these are the care points what I am mentioning you while going through these questions, or while going through this exam of 180 minutes. You take care of these things in your exam. One general transfer pricing rule should be variable cost for plus opportunity cost for as a group. That is a general rule, that is a thumb rule that you should follow. Basic calculations: selling price decided by transfer department for receiving department. Three common methods: fully idle, that is what we have already discussed, fully idle, fully utilized, then cost based variable cost, fully utilized market price variable cost plus, and partial idle, that is average cost. That is what we have decided first itself in the while deciding the pricing of this model. Next, very important one of those things is international transfer pricing. International transfer pricing, when the question comes, student gets a lot of confusion. A student gets, I don't know why, but I have normally seen from the student that when I was teaching this in our classes, in our regular batch, in the fast track batch also, students, their approach to the question, they are a bit scared when it comes to interpricing question, because of a reason is there are various conversion factors, dollars and euros and Chinese yen, Japanese, various currency in Indian rupees, import duty, exports pricing, taxation, and all those are given. See, you people are master of this conversion, all those, because you've already done your strategic finance management chapters there, you have done derivatives portfolio and all those, right? So this should not be a point of issue for you. But what are the important things that you should take care is very important is, number one is conversion rates. So whenever you're solving the questions of internal transfer price, make sure you convert in the one single currency your answer should be. Like say for example in Indian rupees, then your everything should be in the Indian rupees itself. Second is always take care of income tax rates. As we even in our classes in our material, these questions are, even I am explaining this right now, that if I buy from the China and I am not buying from the local, then if I am buying from China, what are the what is the price that Chinese can put, what is the income tax benefit, what is the tax slabs that Indian can gain, what are the tax slabs that Indian tax rates are, all those things are to be considered, and import duty specifically. So if you are buying from China in a question, if you have an option of buying from China division and not from local, because what should be the transfer price if the Chinese company or if a Chinese subsidiary from China supplies to the India, in that case you should decide about your local pricing, how it should be. If you go from local, what is the tax benefit that you can get? If you go from China, what is the import duty you need to pay? So all those consider to be done. If there are more than one units and their production is dependent on the resource which is limited, then use the concept of contribution limiting factor. That is also we have already understood, contribution limiting factor, and rank them appropriately. So say for example China has an external demand, there are various products, rank them on the basis of contribution limiting factor concept. We have already revised this portion and this is how it is to considered. Internal transfer division is charging higher than external supplier, it is always better to price from external supplier. Yes, you cannot charge any time beyond market price. Your substitute product, the buying department will always go for a substitute product, they will not buy it from you. So your pricing should be accordingly set, that is the maximum price should be your market price of the substitute product or the market price available, not more than that. Then we have is P minus P is equal to, that is pricing is equal to A minus BQ model. That is what the questions we have done in pricing. Transfer pricing also, there are few questions where pricing and transfer pricing are put together. So what should be the price of a product? It should be A minus BQ. What is A? A price is the quotation price to earn maximum profit. What is the price that you should put to earn the maximum profit? That is P. That should be a maximum price should be at such a place where maximum that can be quoted at which there is a is a nil demand what you have. So when there is a nil demand, what is the price of nil demand? That is A what you have, A minus BQ. B is what? B is the change in price divided by change in quantity. At what proportion or at what pricing the price has been changing, how the pricing model plays role. And Q is what? The Q is optimum quantity to be sold to earn the maximum profit. So what is the optimum quantity that you will sell to earn the maximum profit? P is equal to A minus BQ. A is the price where your demand is nil. So this is the highest price that you can ask from the market where there won't be any demand, minus what is the proportion of change in price divided by change in quantity, and at what quantity do you want to sell, optimizing sales. What is the what is marginal revenue? Marginal revenue is A minus 2BQ. 2BQ already we have already discussed this. A is what we have, that is optimum price what we set in the market. B is again change in price divided by change in quantities, and Q is what? Q is the optimum quantity is sold to earn the maximum profit. What is the level where you will have the maximum profits? The level where marginal revenues and marginal costs are equal, that is the level where a company will generate the maximum profits, right? So pricing decision how we do is A minus BQ. P is equal to A minus BQ. What is the maximum price that you will put? The maximum price is the place where my maximum revenues, maximum quantity to be sold is the maximum revenues where are equal to my marginal cost. Marginal revenue at that point should be equal to your marginal cost, and at that point your quantity is to be considered, because above that point your marginal revenues will start falling and your marginal cost will remain same, so you will start incurring into the losses. So that point is the maximum point where your marginal revenues are equal to your marginal cost, because with every time you change your selling price, you reduce your selling price, your marginal cost remains same, and therefore your marginal revenue above us after a certain point of time will go into negative. So where your marginal cost is equal to your marginal revenue, that is the quantity or that is the location where maximum quantity should be sold, and for those place quantity should be first calculated. On the basis of that quantity, our pricing of A minus PQ should be decided. With this, we come to the end of our revision classes of this pricing model and transfer pricing revision. For any queries, for any questions, you may contact us freely. We will make sure that it becomes helpful to you. Further, I wish this becomes very useful for you to the revising. This the whole session has made helpful for you to understand every brief, every point. Remember, before you go for exam, this is the last minute revision that you should do. This would be helpful a lot for you people to crack your exams, to get an exemptions. Our exemption key to exemption series is one of those very important which you go for the revision before your exam days or on the previous day of your exams. That will give you a quick revision or a quick brief of how you should appear or how your approach should be. So wishing you all the best. We wish that you get an exemption in your paper number 5, that is strategic cost management performance evaluation. This is AJAY Shah. All the best for you students. Thank you so much for watching this.